So you've got a business idea, a side hustle, or maybe just a burning need to grow something, but your wallet is basically doing a nervous laugh every time you look at it. The good news is you don't need a trust fund, a rich uncle, or a second mortgage to build something real. And we're gonna break down exactly how to move without blowing up your life in the process. Here's what nobody tells you at the starting line. Most small businesses don't die because the idea was bad. They die because the founder panicked, over-leveraged, and made desperate money decisions under pressure. We're talking about people who quit their jobs on day 30, maxed out 3 credit cards by month 2, and told themselves it was investing in the vision. Spoiler alert, it was not. The catalyst here is actually pretty simple. Capital is not the problem. Access to the right kind of capital is. There's a massive difference between money that costs you your sleep and money that costs you a small percentage of future growth. And most people don't know where the second kind is hiding. Think of your day job right now as a life support machine for your dream. It's not glamorous, it's not exciting, but it is keeping the dream alive while it figures out how to breathe on its own. The mistake most people make is yanking the plug too early because they got impatient, not because they got proof. The landscape for small capital has genuinely shifted in the last 10 years. And yet most aspiring entrepreneurs are still operating like it's 1995, walking into banks with a handshake and a prayer. Platforms like Kiva, Fundbox, and even rolling loan funds through your local CDFI community development financial institution have completely rewritten the rules for who gets access to starter capital. Here's where the irony kicks in. Your personal credit is actually one of the least important things when it comes to business funding at the early stage. Yet it's the first thing most people sacrifice trying to grow. Revenue-based financing, invoice factoring, and microloans through nonprofit lenders literally do not require pristine personal credit. They look at your business activity, your relationships, and your trajectory instead. Now, let's talk about the psychological trap, because this is where most people fall off the map. There's a voice in your head, we all have it, that says, if you're not going all in, you're not serious. And that voice has put more businesses in the graveyard than bad markets ever did. History is littered with entrepreneurs who raised small, stayed scrappy, and built empires. And it's equally littered with people who raised big, moved reckless, and became cautionary tales their friends share at dinner parties. The discipline of small capital forces you to be creative, lean, and ruthlessly prioritized in a way that a fat bank account never will. A common misconception worth torching right now is the idea that grants are only for nonprofits or that you would never qualify. That is categorically false, and it is keeping real money off your table. The Small Business Administration, state-level economic development offices, and private foundations collectively distribute billions of dollars a year to small for-profit businesses, and most of it goes unclaimed because people assume they won't qualify without even applying. The practical playbook here looks something like this. Start with revenue-generating activities that cost you almost nothing, document everything obsessively, and build a paper trail that makes you look like a real business. Because lenders and grant committees fund businesses, not vibes. Once you've got 3 to 6 months of consistent revenue records, even modest ones, your options for outside capital multiply dramatically. Here's the counterintuitive truth about risk. Keeping your day job while you build is not playing it safe. It is playing it smart. And there's a profound difference between those two things. Your salary is essentially a zero-interest loan to your business, funding your experiments without charging you equity or interest, which is the best deal in the room. Position size matters as much in business as it does in investing. Don't bet your entire financial life on one product launch, one client, or one funding round. Spread your early tests, keep your burn rate embarrassingly low, and let the market tell you what deserves more resources before you commit them. Discipline over conviction is the mantra here, because conviction without data is just stubbornness in a blazer. The entrepreneurs who last aren't always the ones with the best ideas. They're the ones who had a process, stuck to it when it was boring, and didn't let emotion drive the financial decisions. At the end of the day, the story of small capital is really the story of patience, compounding in your favor. Every month you stay employed, stay lean. And stay building is a month your risk profile improves and your options expand. You don't have to choose between your stability and your ambition. And anyone who tells you otherwise is selling something. Whether you're exploring real estate investing, need home contracting work done right, or want to connect with lenders who actually understand your situation, we can help you take the next step. Check out our links in the description below.